Good morning, everyone, and thank you for joining us. My name is Stacy Varghese, and I'm the Director of Leadership Annual Giving and Engagement at St. John's University. Today, we have John Ceparano, 85 CBA, who will present on financial planning for future success. Some housekeeping rules before we begin. If you have a question, please submit it in the Q&A section, and they will be answered at the end of the presentation. Now, I'm excited to introduce our speaker. John is a certified financial planner and CPA with over 25 years of experience in financial planning, taxation, and business consulting. He's held leadership roles at firms including Pricewaterhouse and Joseph & Company, and has taught business management and finance as an adjunct faculty member at St. John's University and the University of Florida. John holds a master's in taxation from Florida Atlantic University and co-authored The Science of Investing: How to Apply Academic Research to Reduce Risks and Increase Investment Returns. He's also an active community leader, serving on several nonprofit boards and his local Rotary Club. Welcome, John. I will hand the webinar controls over to you now.
Thank you, Stacy. I appreciate that. I have been working, in the tax world, as Stacy said, and financial planning for over 25 years now. And my firm has grown. We've been having very enjoyable time over the last, 20 years building this. But the full satisfaction always comes in with educating people. So I've been working with Stacy and other people at St. John's over the last 20 years doing presentations and educational series topics that can help people from business owners to individuals, young and old. So today, Stacy thought that we could start with a financial planning for your future success, which will cover not only the basic broad areas that you would need, whether you're in your 20s, 30s, 40s, or 50s, or even just about to retire, but sometimes we take these things for granted and we push them off. So let's just get started. And I look forward to your questions later on. Let's get over here. Okay, here are the things that we're going to try to cover today. Setting and prioritizing your financial goals, budgeting and cash flow, investments, asset protection, tax planning, and I'll add a little bonus in there about estate planning, which nobody wants to talk about, but the reality is there's two parts to it: while you're alive and when you pass. We'll focus on while you're alive, and then we'll go over the key takeaways that we. So you already got my introduction. I right now work with my firm, Modera Wealth Management, where I have offices from Boston down to Florida and going in westward. We have a New York City office for any of you that I work with, a number of my St. John's alumni who are clients themselves, and there are actually some in Florida and other places. So my experience has been able to help me in a broad area here. And hopefully today you'll enjoy this presentation. I wear my heart on my sleeve, so we'll kind of go into things with some stories. One of the first things I try to do when I meet with somebody and try to give them some guidance is for them to establish a net worth statement. And what that is listing out all of your assets and all of your liabilities. I will show you an example of one of those. So we know what where we're starting with, and then we can set goals and also know what we're trying to protect to make sure you have the right insurances in place. And luckily in my business, we're fiduciaries, which means that we don't have any vested interest on any of our recommendations because we don't sell anything. We're always going to give the best advice, and that's what you're going to be receiving today as a foundational starting point. So once you have your assets and your liabilities, we also want to get a grasp of what sources of income you have coming in right now and what are your current expenses. And then we'll break your expenses down into needs and wants. Nobody wants to create a budget without any fun in it. So there's lines in there for like vacations and doing things socially. The next thing we will cover in terms of cash flow is making sure that you have a cash reserve. Now, many people talk about a 6 to 18 month worth of expenses. So if your monthly expenses, well, let's just say $5,000 a month, nice round number. At the minimum, according to this, you should have $30,000 or $90,000 sitting in something that's a liquid like a savings account or a money market account. And this is on top of having money for your monthly bills. However, what I see that's more practical for most people, if they have their own business and they've got consistent cash flow, or they feel that their job is safe, and they feel like if something ever happened to the job, they can get into another one, typically within 3 to 6 months, then I typically tell people to focus more on the 6 months opposed to 18 months. But every person and family may have some unique circumstances. For that money, because you don't want to take any risks here, you want that to typically be federally, the FDIC insured. For an individual, it's 250,000. For a couple, it's $500,000. You may want to write this down, that right now the yields out there for a high yield saving, which is usually with an online account, you can go to places like Ally Bank, or another one which I've been a favorite of and fan of is called biobank.com. You'll see that their rates are above 4% and have been for quite some time. And they've been competitive that way for the last 10 years. And I use it myself. So the order of priority here, and when we're doing all this, is what your savings are going to be, and then breaking down into needs and wants, in terms of material things or vacations and of the like. So let's go on. So there's a lot of things that are competing for your personal finances and things that you've got to deal with, which is why a lot of times people just push this stuff off. Because it can be overwhelming trying to balance, what do I do first? What do I do second? And create a priority from, where's my employment? What's my current debt, from school or house or car or whatever? How much can I save? What's my Social Security going to be look like when I retire? But when you're in your 20s, 30s, and 40s, you're not thinking about that. You're listening to the news and saying Social Security is not going to be there. I'm not going to get into political things, but that would be in today's date and time political suicide. So those things will sort it out. Tax advantage, knowing how to take advantage of things so you can minimize your taxes now and in the future. Talking about retirement, and we will go over that and how to save for it. Also, with your after retirement savings, how do you set things up in an investment account? And then we can go into your credit, mortgages, and insurance. So we're going to cover all these topics. So one of the first things you got to sit down with is say, here's what I have today. You create your net worth statement, your assets and your liabilities. And assets minus liabilities equals your net worth. So you want to know where you're starting as a starting point. But then one of the first things you need to do before you can start really investing is to make sure you have that 3-6 months or otherwise emergency fund. And the reason I say that is that if you start trying to put money into investments or just your retirement accounts right away, you can't get that money out without serious penalties and taxes, because they're usually pre-tax, and we'll go over those choices in a little while. So setting aside your emergency fund will help you out. So no matter what you started savings, you won't have to go touch that and can use your emergency funds first. And the only thing that's going to happen there is that it just won't be earning as much. It won't be earning as much because you'll take it out. If you established a emergency fund of, for argument's sake, $30,000 or $40,000, and you took out $5,000, the worst that's going to happen there is that you do not make any more interest on it, but it won't hit you with high taxes on capital gains or having to take it out worse out of a retirement account. Next is, what are your goals? Overall big picture here: save for a house, save for retirement, pay off credit card debt and student loans. That is a big one that I want to make sure that we cover. Just got some notes here. And make sure that if you have children and you're married or not, and you want to help them save out, how do you balance that out versus paying down your credit card debt versus paying down your own loans or a mortgage or saving for retirement? It's a juggling act, and we can help you with that by helping you prioritize things. If you want to become a business owner, how do you set aside money for that and then create a business plan for that? Those are things for a separate webinar, which we'll be presenting on in the future for business owners. And then, of course, investing for your future wealth. So it's not only about getting a handle on your current liabilities, but how do you slowly build wealth over time? And it's basically 5 places that you can put your money to try to build wealth. There are banks, there are bonds, there are stocks, there is real estate, and then there's a business. So depending, if you don't want to own a business and you'd rather just be an employee, and I don't mean that as a negative, but I mean you're good at it and you just don't want to run a business, then you've taken out one element out of there. And then you're down to your real estate. Most people, when they're first starting out in their 20s or 30s, are deciding whether they even want to own a home anymore. But if you do own it, there's benefits to that, and we'll go over that shortly. So these are some of the things you have to set. And there may be many other goals on here. Taking care of parents may be something you have to help out with, let alone children, and you're sandwiched in between when kids can't find jobs right out of college as you get into your 40s and 50s and they need some assistance. So there's a lot of things pulling at us. So I want to talk about credit card debt. It's one of the worst debts that you can have if you have a high interest rate card. I'm not talking about going from one zero interest card to another, but I'm talking about if you had like a $3,000 balance at a 18 or 21% interest rate here, you know, if you take a long period of time to pay this off at only $75 a month, and maybe that's all you can do initially, if you can double that and get to 150, you can save yourselves not only years and the stress of having that debt on you, but you could also save yourself a significant amount of money because the interest rate is so high. Going from paying it off at $75 a month could take you almost 6 years. Versus if you double it, you can get it done in almost only 2 years and save yourself $1,500. So this is just a simple graph on how that looks. But I think it's also the emotional stress of saying, I got to get rid of this debt. So credit card debt is one of the first things that I always look to help people try to get out of if they're in it already. Next thing, let's just talk about the credit cards themselves. Now, credit cards can be used in a very positive sense, but there's some cons to it. So let's talk about the cons first and then be positive on the end of the slide. I know I have this backwards. One is you can have high interest rates. I'm not, other than like special promotions, which are usually short term anyway. The fees can be high if you have late payments, if you miss something. It's too easy to spend money on a credit card if you're not paying attention, and all of a sudden you get surprised at the end of the month and go, how do I have a $3,000 or $4,000 credit card bill? I didn't think I spent that much. So we'll talk about that, and the way to do that is to keep track of it and know when you spend up to a certain amount by looking once a week and say, what is my balance up to on this credit cycle? You'll realize that you've got to maybe take it easy, so you can kind of plan that out over a month. Some of these things may sound so obvious, but I hear so many people that even make a lot of money that they're blown away as to what's on their credit card. And it can also, if you miss payments, don't pay enough down or carry too much credit, it can destroy your credit. And I will tell you, during your lifetime, if you have a bad credit score, under 700 and definitely under 650, it can cost you a lot of money in so many aspects of things because it is used in many cases, including car insurance. They look at your credit history. So your rates on your car insurance can go up. It impacts so many things that so many people just don't even pay attention to. So managing credit card debt is crucial. So let's talk about the positive sides of it. You have purchasing power. You can use this so you don't have to carry cash and worry about, getting robbed or pickpocketed or anything else. The rewards can be huge depending on which card you have and what you want to use it for, whether it's like mileage for travel or whether it's just cash back. And there's all different cards. And depending on your circumstances, different cards are going to be better off for you. And we can talk about that another time, but I will build over the key issues. It also helps you build credit. When my sons went to college at around 18 years old, I made sure that they all got a basic credit card and they used it and they knew how to pay it off. And they had to have a small job, being old-fashioned, little things like that. It helped them take on responsibility. The other thing is that, quite frankly, it could be used in the form of an emergency. If a big ticket item came up that you had to pay for and didn't have cash readily available, you can use the credit card and know that you probably have anywhere from 30 to 45 days before it's due. And then the last thing is fraud protection. And the reason that that's important is when you use a credit card, they changed the laws, don't quote me on this, maybe about 15 years ago or so, where you just have to let them know that you lost your credit card or there was a fraudulent activity on it, of which case, and many times they're alerting you first because now they're on the hook the way they changed the law. So credit cards can be used very positively if you use them responsibly. Okay, next one, repaying student loans. I know everybody in this call went to St. John's. So some of us left with debt. I did, and luckily I was able to pay it off in the first 2 years. But some people have gone on, and not only could they not do that, but then they went on and got master's degrees, or they became a doctor or an attorney or whatever advanced degrees that they got, and it cost them money. I have one doctor that I've helped try to manage all this student loans, and over the years, because she took out one per semester at various different times, she had 9 different loans. And guess what? Each of those loans had their own options on how to repay and the criteria when they were due, when they started, whether there was any forgiveness on them. So there are a lot of things to look at with this, and it could be overwhelming. So getting a handle on repaying your student loans in conjunction with any other kind of debt is very important. However, deducting student loan interest payments, you can do that up to a max of $2,500 a year. But there's some phase outs. For single people, if you have your modified adjusted gross income, for most people, that's your adjusted gross income. As a single person of $85,000, you can deduct it all. But it gets phased out by the time you get to $100,000. And for a married couple, it's just double that. At 170, you can take out up to that if you have $170,000 of household income, and then phased out by 200,000. So depending on whether you're under those numbers or in the middle or past it, you can either get some of that benefit and help you save some money on taxes. So this is also something that's really been wrangling a lot of people who have student loans. Next, I want to just talk about budgets. Now, this is a very simple budget here, and many of you have many other line items, which is what I help people out with, a simple spreadsheet, and say, take a look at your check register online, or whether you do it old-fashioned in paper, because even if you have credit card, you use a credit card, you'd have to break down those credit cards into the types of expenses, so you can see where you're spending your money and also where your money's coming in from. Maybe you, if you're married, you maybe have 2 wages, maybe you have a rental property, maybe you have a business, all different sorts of ways income come in. But where people really can try to control things other than, getting raises or expanding their business is going to be on the expense side. And then you want to break your expense side down into the things I alluded to earlier between your needs and your wants. Having a place to stay is going to cost you money, whether you have a mortgage or whether you pay rent. Utilities, student loan minimums, car loan estimates, auto insurance, car expenses, fixed monthly expenses like cable bills and other things. And of course, you don't see it on here. You could put in there things like vacation, eating out, food, all these things. But this is overly simplified. And once you get a handle on what this is, you can have an idea of actually what you can save, and also the line items where you have choices over. And when you do get raises or a bonus or an unexpected inheritance or a lottery ticket, whatever it is, obviously don't go to try to spend it right away on fun things. Look at where you can pay down debt first and take off that burden off your head that you can finally get ahead or start saving a little bit more and expedite things. So budgeting is a great place to kind of do self-reflection on where you are and what you literally could save by the end of the year. You'll have to take into consideration things that are not paid monthly. Also, like typically insurances are not paid monthly for most people. They're paid quarterly, semi-annually, or annually. And then maybe some other things that are paid annually, like other forms of insurance, all different types of insurance. That is something we can also talk about. We can send out sample budget worksheets so you can get a handle on that. Okay, saving for retirement. If you are working for a company, whether it's your own or you're working for a company that has a 401k plan, that's for a profit business, or you're working for a non-for-profit, let's just say like a hospital or something that's non-for-profit, it's a 403b. They're virtually identical for all considerations. But the thing that's important here is to know your age and your tax bracket. We'll go over tax brackets in a minute. But here's my recommendation. If you're just starting out, whatever age you are, and your income is in get you to be, even after deductions, in the 12% bracket, I would suggest that you put money into Roths, whether it's a Roth IRA or whether it's a 401k Roth if they offer it in your 401k plans. And most companies today, they should have the alternative to not only put money away into traditional pre-tax deduction, but they should also give people who are in a lower bracket the opportunity to put into Roths and save that money. What is the difference between those two? While you're working, the traditional 401k plan or IRA reduces your current taxes. And if you're in a 12% bracket, that's not a big tax savings. So you'd be better off statistically to put that into the Roth. Okay, we'll go over limitations on how much you can do in just a little bit. But if you put it into if you rise up to the 22% or 24% bracket, now you should be considering putting it into the pre-tax choices that they have there, on whether it's a 401k, 403b, or even in a traditional IRA if it's not offered through your companies. So if they have an employer plan, do that. Now, in many of the 401k plans, they also offer a match up to typically 3%, 4%, or maybe even 5%. And some are even higher, which I've been shocked at to see some of these plans that are out there, but most are around 3%. So if you typically put in what you'll see is around like 5%, you can put up to 4%, or maybe it's limited to 3%. But whatever they will let you match is a free bonus that you don't have to raise your hand for. So I would take advantage of that all the time. Because if you put in your 3 or 5% of the match the first 3, you're already doubling that to 6. If you could put in the 5 and then you add the 3, now you're up to 8% put away, and that will compound over all the years until you retire. And if you're changing employers, you have the choice to, typically, you have to ask if they accept it, to roll over from one of these plans, 401k or 403b, into your new employees plan if they have one. And the benefit to that is there's no fees, there's no cost to you directly, typically, depending on how the plan is set up. These are things I've helped set up for businesses over many years. And the last one just makes things simple for you. However, if you are a person that likes to do your own investments, then you may want to roll it over from a current plan to a self-directed IRA. And then you could, if you're savvy enough to do this on your own with a little bit of training or working with a financial planner, start to put money into a self-directed IRA and manage it yourself. Okay, let's go over a little bit about what I just said, but I'll throw some numbers on here too. A 401k plan on the upper left-hand side here, the way I'm looking at this, gives you many investment choices. Typically, most 401k plans, for simplicity, narrow it down to about 25 to 30 investment choices. And then they further break it down into 3 types of choice clusters that you have. First choice will be just very simply, if you're one of these people, I really don't want to know about this, or I don't have time to figure it out, or I'll get to this later, you can pick a target date plan. And what that says is that if you're 25 today, you can pick a target date plan that has you retiring at 65, which is 40 years out. And what will happen is it will slowly start out from being very aggressive in terms of how much is in stocks, 80 or 90%, and only 10 or 20% in bonds. And as you get closer and closer to retirement at 65, if you're still working for the same company, or they have the same thing at the next company you're at, it will slowly get more and more conservative down to maybe only 50% in stocks and 50% in bonds, so that it doesn't have as much fluctuation just at the time you're about to retire. So that's the first cluster. The next cluster would be a fixed self-rebalancing cluster where you have a static portfolio that's either 40% in stocks, 60% in stocks, 80% in stocks, 100% in stocks. And so that you don't have to go in there and change anything. It will automatically rebalance itself. That makes it easier when people know what the allocations are that they want and like. The last cluster would be where you may have some outside assets, or you want to create your own portfolio, and they'll give you another choice of 10 or 15 of this whole, laundry list of investment choices where you can make up your investment choices to specific asset classes, large companies, small companies, US companies, international, smaller companies, larger companies, bonds, different short-term, longer-term, and the like. So you can customize things. So that's something I want you to be aware of in the 401k plan and the Roths. And in both of these, you can save up to $23,500. Now, if you don't have the salary to do that, you do up to the amount that you can afford to do. So the 401k plans are pre-tax, the Roth are after tax, which means you'll pay your tax on whatever you put into this. But then as long as you're alive into 10 years after it, going to any heirs, the funds in the Roth will never be taxed. They will grow tax-free after that. So that's why many people in the low income tax bracket like it. Traditional IRAs have less in terms of the maximums that you can put in per year, $7,000 each. And the same thing, pre-tax or post-tax. And on all of these, except for the Roth, when they come out on the 401k and the traditional, they're going to be taxed at your tax bracket when you're in retirement, when you start taking it out. Next, let's talk about investing a little bit in more detail, or a bigger, broader picture here. Risk and return are related. The less risk you take, the less the return is going to be. The more risk you take, the more return is going to be. But let's put that in another framework. You have to do that in the context of time. If you have a very short period of time and you know that money cannot fluctuate too much, you would not be wanting to put it into stocks, for example. You may want to keep it in a bank account, like your emergency money that we talked about earlier. But if you knew that you might want to keep it there for maybe the next 4 or 5 years before you buy a house or something, you may want to put some in stocks and a lot more in bonds, for example. You wouldn't want to let it sit in a bank account earning very little. And we'll go over those kind of returns in just a moment. But if you're looking for your long-term money and you put things in pots, emergency money, saving for a house money, for my kids' college, if you have any kids, or for my retirement, when the time frame gets longer and longer, you can take more volatility in your portfolio because you may not need it for 15, 20, 25, 30, or 40 years, depending on what your age is and your time frames. So risk and return, even though there may be a lot of fluctuation in a short term for anything you put in stocks, it gets mitigated over time, and you get the reward for being patient and knowing that it's over a long period of time. You'll get those rewards when you put it in stocks. And stocks have, over a long period of time, outperformed bonds and real estate. So it's not so much any particular stocks I'm talking about, but I am saying as a whole basket, and through diversification, you won't have to worry about individual stocks tanking and going under, because you'll have thousands of them in order to get those long-term rates of returns. Okay, so here's a great example of what I just said. The least risky are on cash because it's also FDIC insured. As you go to the right in treasury bills, okay, your rates of returns go up. Then there's bonds. One that I didn't put in here is real estate. It would go in between bonds and stocks, and then stocks. And even within stocks is different types of risk levels, and even within bonds is different types of risk levels, both treasury and regular bonds, corporate bonds, or even municipal bonds. The longer you go out with bonds, and bonds, all they are is a loan to the institution that's paying you the interest, and they're paying you back for letting them keep it over a period of time. Typically, what happens, a longer period of time you keep it with somebody, the more they pay interest. That has kind of changed over the last 5 years or so, where after about 4.5 to 6 years, depending on which type of bond and which type of treasury bill you have, the longer you keep it out, you're not getting rewarded currently for the longer time period. So we're recommending for people to have the average length of time you're going to leave this money out there. Loans, if you're looking to get a decent rate of return for the time you're putting it in, is somewhere around between 4.5 and 6 years. Past that, you're not getting rewarded for the length of time you put it in bonds. That's very different with stocks. Stocks over long periods of time, they'll fluctuate a lot in very short periods of time, up and down. But over long periods of time, you're going to see rates of return in excess of 10%. As a matter of fact, I just looked up these things just this morning through the end of last year. And the rates of returns on cash right now, not money in checking accounts, but like an online bank, like I talked to you about before, if you get a really good one, they're making between 4 and about 4.2% right now, which is very good. But that will go down or up depending on what the bank's doing. That can change very quickly because it's not locked in. Treasury bills are held until the maturity typically, and those are typically earning a little bit more between 3.5% and 5%. Bonds are earning anywhere from 4.5% to 7%, depending on which ones that you have. And stocks, they've averaged over the last 40 years, by the way, bonds 5.4%. Real estate is closer to 6%, plus a little bit, depending on what type of real estate. And a broadly diversified stock portfolio is over the last 40 years made on average per year 11.2%. So you're getting rewarded for time, you're getting rewarded for risk, but if you want that reward for time and risk, it also has to be money you don't need or anticipate needing. Okay? Next, let's talk about a net worth. Remember before I said one of the first things you should do is create a net worth statement for you? Well, on a net worth statement, you add up all your assets, and this is a very simplified one. People have many more accounts and other things that they have here. So here's an example. You have a checking account, a savings account. You can also have a brokerage account, money that you put in here that is beyond what you put in retirement accounts. Then you have your retirement accounts, whether you're single or married. You can have one or more. You can have IRAs, you can have 401ks. And then you'll see your total liquid assets. Those are things that if you sold them, you can get your money out. Now, the reality is retirement accounts, they're liquid, but they may become with penalties if you take them out before age 59 and a half. And there's some other restrictions other than hardship situations. But we don't have time to go into that. But the thing that's most important is looking at your non-qualified assets. Those are the things that we want to make sure that we cover with the right insurance in terms of personal liability. So if you ever get sued, they can't take them away because retirement accounts and many primary homes in states are covered by law in terms of being sued. So if it's your primary residence, typically it's either 100% covered or up to a certain amount by state. All retirement accounts are covered up to the first $1 million in IRAs, and in some states it's unlimited, and in all 401k plans and 403bs, it's unlimited protection. So those are things you need to know. And then, of course, you want to list out your mortgages and then try to pay things down, like using this one as an example, student loans at a high interest rate. This is critical that you create one of these. Next is trying to say, what am I going to look like over time if I save this way and my facts don't change too much other than my savings? This will help you see where you can go, and you can start to get excited about what your future looks like, even if it's starting to get rid of debt, so your net worth starts to grow. This is something, that you can do on your own, or you can work with a financial planner to help you plan for these things. And this is also assuming that, you contribute 6% to a 401k plan and you happen to be with a company that matches 3%. That's what this one is. And under those assumptions, this is what would happen with your net worth over time. It will skyrocket over a long period of time from very little over a long period of time over the next 40 years or so, 50 years, to be significant growth. And then, of course, when you stop working, of course, it'll slow down if your expenses don't exceed your income at that point and you're not pulling too much out of the portfolio. You can still pull money out of the portfolio, which is the whole point of it. But if you jumped to where you saved it at 10%, your money plus the match, you can see how at some point when you can start doing that, or start even more immediately, how your growth is exponential, where it can basically help you save an extra almost $650,000 by the time you're 90. I'm not saying that everybody's goal is to, be multimillionaires and they can be happy at a lesser amount, which you have to find balance in. But if it's excess money that you don't need, this is a way to accumulate wealth over time. Asset protection. We have four things I basically want to cover with you. When you're younger, life insurance is typically very important if you're married. Typically, if you're single, it doesn't matter because when you die, your assets are with the assets, your liabilities what they are, and after you pay off your debts, your estate will just pay out whatever's left over. No big deal. But when you're married, or when you have children, or you have other responsibilities that other people are counting you on, life insurance can play a key component. Most people only need term insurance, which means that you need the life insurance for a certain period of time. And you could even have in different lengths of life insurance where you need so much for like 20 years, so much for 10 years, and so on to limit the cost of life insurance. We can have a whole discussion on that. While you're working, disability insurance, which means replacement income if you can no longer work, is very important, especially if you're the main breadwinner in a home. Okay. So typically, disability insurance, the type that you want to get is not general disability insurance, but what's called own occupation. And the reason that is the case is because if you have own occupation, if you can't do the same exact job that you're doing today, they can't, under a general disability insurance policy, just say, well, we got another job for you and you can still work. And therefore, no, we're not going to consider you disabled fully. And therefore, you may have to accept this other job that pays you a lot less. That would be horrible. Next one is property casualty insurance, making sure you have the right types and rights amount with the right coverages to protect your other assets, including an umbrella liability insurance, which is personal liability. Like if you ran off the road to Mr. Squirrel and you hit somebody, you're probably going to get sued and they're going to go after whatever assets they can. That's why umbrella insurance is one of the most affordable insurances compared to any other ones. So like most people can get $1 million worth of umbrella insurance depending on what they need. And it could be anywhere from $250 to like $500 depending on your circumstances. But it is a fantastic tool to protect the wealth that you're trying to create. And then of course, health insurance is going to be important because you couldn't afford a long stay in a hospital that could be catastrophic if you didn't have health insurance. So that's important. Life insurance, we kind of went over this. There's different places that you can look, but here's one example of termforsale.com where you can start to look at these things. If you have any help, Stacey will surprise some things and I'll be able to give you some direction. The amount of insurance should be specific to what you need, so you have to figure it out yourself. You may need some assistance, but I'm not knocking anybody in insurance, but insurance people's job is to sell insurance. That's their goal. If you have a really good one, they'll do the best job they can. And so it's really nice if you can get somebody that would sit down with you or you and your financial planner to coordinate your needs. Let's go to the next one. Quick one on tax planning. Know your tax brackets. This will help you when you decide to put money into either 401ks, traditional, or put it into Roths. Like I said, if you're in a really low bracket, you want to stick with Roths, I'd say definitely up to the 12%, but it also depends on whether you're a single filer or whether you're married filing joint, depending on what your source of income. So I'd say anything from 22% and higher, you're going to really want to consider getting the tax benefits now because the odds are that when you're in retirement, you're going to be in a lower tax bracket, especially if you're going to move from a state that has also state taxes to a state like Florida, for example, or other states that don't have any tax. This is very important. And one last thing related to taxes, but I'm going to call state taxes. What's really important, and I don't have any slides on it, is this. If you are a parent and your kids are going off to college and they're 18 years old, you no longer have the right to make decisions for them legally, because as soon as they turn 18, they have to appoint somebody as a power of attorney to make financial decisions for them. And for healthcare decisions, which is typically called like a healthcare surrogate or proxy, you will have to have that. They will have to have that form in place to designate a parent. Now, once they get married, if they do get married, their spouse could take over that role and they'll have to have their estate planning documents. So those advanced directives, power of attorneys and healthcare surrogates are important for them, let alone yourselves. So those are the key things that I wanted to talk about today, and we'll get to your questions in a moment. So overall, establish a plan and financial goals like we talked about at the beginning. Prioritize your cash flow so you can pay off any unnecessary debt or expensive debt, and then you can start saving and create by doing a budget so you know what you could save and not be disappointed. Invest early and often. It's better to start saving even a little bit than wait 5 years and then start saving, because compounding of earnings is huge. Allocate where your money is going to go based on your goals, your risk tolerance, and time horizon. That's related to the investments we talked about. Understand your employer retirement plans, or sit down with your HR person or get help from a financial planner to help you understand your retirement plans. And even a CPA may be able to help you, like I am as well, to be able to do this. That's why my background experience is very helpful in helping guide people make these kind of decisions. And then the last one there, invest in yourself. Don't make savings the last thing you do. Look at your fixed expenses as they are right now, decide whether you can change any of them, put savings in there, and then look in there to do some other things like bigger vacations and other things, or other types of investments. And make sure you have the right type of insurance and the right amount, so that all your hard efforts and accumulation of wealth is not taken away from you by accident, from an inadvertent accident that nobody plans for. That's what I wanted to cover. So I'm going to stop sharing, and I will come back over here and work with Stacy to go over any questions that we have right now.
Great, thank you, John. All right, so everyone just feel free to ask any questions in the Q&A section. I do have a few that I was actually emailed. So
Okay.
First was for credit card debt, is making minimum payments enough?
No, because minimum payments on that slide that I gave you the example, it's like paying something off over 5 or 10 years. Now, if you have no other choice and you have to make the minimum payments, then definitely be making those minimum payments, because if you miss them, your credit's going to ding like I talked about and before. Anything you can do to add towards that would be helpful. If you have money saved beyond a what do you call it, a emergency fund amount, or even if you had money in a brokerage account and have a small gain on it, it's better to take out that gain and pay that small tax on that to lower that credit card debt. Because the gain on if you're in a low tax bracket, actually some gains, if you're in the 12% bracket or less, there's zero capital gain tax. So if you had to take some money out, $5,000 or $10,000 to pay that thing off, it's better than paying 21%, because even your investments will stop earning, maybe even if it was 100% stocks around that 10 or 11%, but you're curtailing paying out 21%, you're going backwards. So try to do as much as you can beyond minimal payments as fast as you can.
When your child is 18, is it better for your child to get a card under one of yours? For example, if you have an American Express, get them one in their own name.
If they can apply for one and get one on their own, even if it only has a max of $500 they can spend on the thing. I mean, how much should kids be paying for in college anyway, right? But I would get them in their own name. However, I didn't tell you this. I actually got cards in my wife or my name, and then I added the kids. I didn't think it builded their credit, but it actually does. So then putting on $100 and paying it off, $140 and paying it off, even if it's the meal plan in college, it doesn't matter. Have them used to getting things on it and paying it off. They're looking for a long-term history of financial responsibility to not only using it and not using it to the max all the time, but also paying it off monthly.
And finally, what is your opinion about using a debit card as opposed to a credit card?
Well, it depends on how you are good at taking a responsibility for how much you're charging. If you knew that you can put, I'm making up a number here, $1,000 of charges that you can gain points or reward and keep track and then pay it off, okay? That's going to be more beneficial than just using a debit card and just paying your bills because the bank's going to give you nothing for it. However, if you're not keeping track of it and $1,000 it goes past that and you don't have the money to pay for it, now you're going to be paying interest on it, or worse, you can't make those well, I'll assume you can make the minimum payments, but you're never going to get out of debt, or your debt can start to build. So if you can, and I know each of you can do this, is maintain how much you know you could pay off in a month. When you see your credit card bill get up to the $1,000, stop using your credit card. And at that point, only use it in emergencies. And then therefore, then use your debit card for the remaining part of the month if you knew you had some cash in there, just so you get in a good habit of watching your credit card balances.
A question just came in. Would you recommend using the equity in your house to pay off debt or to do renovations? What are the cons of doing this?
Okay. That it seems like a simple question, but I'd have to know more facts. In general, first of all, the bank's not going to want to see you go below a certain equity threshold. So you don't want to be like, just buy a house in the first year or two, you only put 20% down. Your equity builds up very slowly at the beginning because a lot is going towards interest. They may not even let you take more than a certain amount out, so therefore you may not have that option. But if you've had the house for 10 years, 15 years, you got a 20-year mortgage or longer, and you have some equity in there, if you know that you can pay it back in a certain period of time, like within 3 months, 6 months when you get a bonus, sure, using your equity is great. Now, what I would do is, we didn't get a chance to get into these things because there's so many things I can try to teach you on. I would consider, if you have equity in your home, it's kind of the same thing, but it comes at less fees, is go try to get a 25,000, and they'll have low doc, meaning you don't have to go through a big appraisal or anything. You can go get a line of credit on your house, which means that you're not going to pay any interest unless you borrow it. So if you knew you had short-term cash needs, and I've done this for a long time, I used to have a $300,000 line of credit on my house. I just reduced it down to 100 because I know I'm not going to have any big things anymore, but it's always available. I don't have to sell anything. And if I knew that I was going to get a bonus check, or I knew that I was going to be selling something I don't need in the next 2 months or 3 months or 6 months, paying interest even at 6 or 7% for 3 months on $10,000 is really nothing. Think about it. At 6% over 3 months for a whole year on $10,000 would be $600. For only 3 months, it may be only like $200, and you didn't have to sell anything. You don't have to have any tax consequences on it, and it's simple. Just pay back that loan. So, but one of your questions was a renovation. Typically, I tell people to hold off until they have more money down if they can do it, or suspend putting money into the 401k plan. It all depends on the interest rate that they're going to charge. So interest rates are key on that, answering that question. If the charges, interest rates are 7% plus, or 6.5% or 7% or more, I'd hesitate to build up a little bit more equity on that, or build up more cash and have money to put down on those renovations if you could. So I'd have to know more information. If they want to send me that question and I can talk to them on knowing more of the details, then I can help them give them a little bit better guidance than just a broad answer.
Okay, great. All right, so I think we're a little over time. John, do you have any last thoughts you would like to share? And then we can close up.
No, what's most important is when you listen to these kind of sessions and saying, okay, I think I've got that part, I got handled, I knew about this or that. The 1 or 2 things that you don't may be in this categories that we talked about. And what I would do is to help Stacy and I go into more depth in certain areas or topics we didn't even touch on today that may impact you financially, whether it's for your kids, whether it's saving for 529 plans and all those kind of things, and the details on how to find the best ones. Because one thing we didn't talk about in investing is investing is great, but you have to know what you're paying for the investing. I'm not talking about just for the financial advisor. I'm talking about the investments themselves. There are some fees that are buried in the investments that you charge that can be very expensive, 1% for a mutual fund, or even 0.8. The things that we look for are institutional costs, which can be anywhere from close to like 0.03 of a percent to 2. And therefore, the less you pay in fees, the more it's going to compound. Your rate of return is going to be dependent on the value of what you have, not only the cost for things, but the advice that you get. Because sometimes people are hesitant to use a professor and go, oh, it's going to cost me. The idea is what they're going to be able to save you in knowledge that will be the rest of your life if you put those things in place. That's not selling me. That's just a fact on what any kind of profession is, whether it's attorney, medical doctor, CPA, certified financial planner.
All right, great. Well, thank you, John. We appreciate you being with us today. And thank you everyone who joined us. Please go to www.stjohns.edu /APD series for future webinars. And I hope you all have a great rest of your day. Take care,
Thank you,
John. Thank
everybody.
you.